Hi, everyone. I'm Zach Gast, a member of the International Accounting Standards Board. I'm here to provide a very brief primer on what supplier finance arrangements, such as reverse factoring, are. This brief video is intended as an introduction for those interested in learning more about these arrangements before reviewing the IASB's exposure draft on supplier finance arrangements. There are a range of programs that would qualify as supplier finance arrangements, and I'm sure lenders will diligently create many more. We thought it would be helpful to provide a basic description of what a typical program might look like. The arrangement shown in this diagram, which is usually known as reverse factoring, is amongst the most common. If you look at the chart on the left, we'll start with the basic transaction that occurs at most companies, which is the receipt of a good or service by a company provided by a supplier. Usually, a company would have a certain number of days to pay for that good, say 30 days. In a reverse factoring program, the purchasing company could agree to pay a financial institution at 30 days, but allow the supplier to access their funds earlier, usually by accepting a small discount to face value. If the company usually paid its bills within 15 days, that extra 15-day window would free up cash for the company when the program is initiated. Realistically, that would be a small change in working capital, but meaningful if done with enough suppliers. What sometimes occurs in practice, though, is that a company might tell its suppliers that it will now pay in 60 days, but they can access their funds earlier through the financial institution. In some cases, it is still a good deal for the supplier, which might be a small company with no credit rating or poor credit terms. That's because the company's credit rating, not the supplier's, generally determines the discount associated with accessing funds earlier, even though the supplier effectively pays the interest. So the supplier might still come out ahead in this arrangement. With an extension of payables from 15 days to 60 days, the effect on working capital and the cash conversion cycle starts to become quite meaningful. So that'll conclude our primer on supply finance arrangements. We hope you'll continue with our next video describing the IASB's exposure draft on supplier finance arrangements.